How to increase your maximum affordability when buying a property. Hey there, and welcome back to People Friend, your favorite channel dedicated to helping you find and get the right mortgage options. My name is Luca, I'm a mortgage expert, and today we're going to break down 7 practical ways to increase the maximum you can afford. So let's get right into it. Tip number 1, buy with a second person. What's better than one income? 2 incomes. If you combine your incomes, then you're eligible for a bigger loan amount. The person that you combine your income with doesn't have to be your spouse, doesn't have to be your partner. They can be a friend, they can be your colleague. As long as your interests are aligned and your incomes are combined, you should be able to qualify for a little bit more. Now, you have to make sure that you choose the right person. If the person is a visa holder or a blue card holder, then you may not have access to all the banks in Germany, and therefore you'll probably not end up with the best interest rate on the market. Also, if the person is freelancing, you have to make sure that they've been freelancing for at least 3 years to prove 3 years of tax returns to the bank. If the person is an employee, then you only need 3 pay slips and for them to have preferably passed probation, and then you're pretty much good to go. Now, when it comes to co-signing, just keep in mind, not all borrowers have to be owners. So if you're working with the right bank, then technically you can just combine your incomes, get the mortgage, and then one of you is the owner. That being said, make sure that you know what you're doing and that you speak to the right people, because banks have different criteria. And some banks, this would be considered money laundering, because for them, all borrowers have to be owners. So please do your research. If you want to know how much you can afford, a simple rule of thumb you can use is multiply your net income, in this case your combined net income, by 100 to get the loan amount that you can qualify for. Tip number 2, buy a fixer-upper. If you find a property that's completely run down and needs a lot of work, then actually this can be a good investment opportunity sometimes. Keep in mind, it's really hard to buy a property that's in a bad state because one of the things that the bank uses as collateral is the property itself. So if the value of the property isn't that good, then the bank doesn't have enough collateral and getting a mortgage is impossible. That's why the bank is going to need you to apply for the modernization together with the mortgage. So, speak to a construction company, get a quote for the costs, go to the bank to get it all approved, and then the costs for the modernization and the mortgage are packaged together so you can pay them all off together over time. That way, your modernization costs are also repaid over 30 years or so, making your monthly payment a lot more manageable. Tip number 3, buy a rented out property. If you find a property that has a tenant, usually that tenant has been living there for a considerable period of time. If they have a long-term rental agreement, chances are that the rental yield on that property is very unattractive. In other words, the current owner isn't making a lot of rental income and they can't get rid of that tenant. So if they try to sell the property, it's very, very difficult for them to sell it, allowing you to potentially buy it at a cheaper price. Now, keep in mind that if you buy this property and indeed the tenant has, for example, an unlimited rental agreement, it's not going to be really easy for you to get rid of that tenant either. Tenants have a lot of rights in Germany, especially if you're living in Berlin, for example. But what you can do is you can make an offer to the tenant between 1% and 5% of the property price to ask them to move out of the property when you do it. And if you can reach an agreement with the tenant, then sometimes you can buy a property that is tenanted for over 10 to 20% less than the market value. Tip number 4, rent a room out. If you're living in a big city, then as you might be aware, people are willing to pay 500-600 euros a month just to live in a room. Now, unfortunately, as depressing as it sounds, that's an opportunity that you can take advantage of. So say you're buying an apartment that has 1 or 2 extra rooms. What you can do is you can declare them as rental rooms. Now, the bank is going to estimate a projected rental income that you can add to your own income, which will allow you to boost the maximum you can afford. Keep in mind that the bank is going to take a lower projected rental income for these rooms. So don't be too optimistic with the maximum you can afford, and make sure that you speak to somebody that knows what they're talking about so that you can plan accordingly. One cool thing that you can do is buy a multi-family house. If you buy a big enough house that has 3 to 4 different apartments inside it, then you can rent those units out. Hopefully, if you're buying in the right city, you can generate enough rental income to cover the mortgage cost, allowing you to basically live there for free. Tip number 5. Pay off your existing credit loans. When calculating the maximum you can afford, as mentioned before, what you do is you take your net income, multiply it by 100 to get the maximum loan amount that you're eligible for. Now, this is a simple rule of thumb. It's really not that simple. But let me give you another simple rule of thumb. If you have a credit loan, what you can do is deduct the monthly expense of that credit loan from your net income, and then use that new value to multiply it by 100 and get the maximum loan amount you can qualify for. So if you get the math right, you might reach a logical conclusion that these credit loans are actually making it a lot harder for you to get a bigger property. So a smart thing to do is to pay these off right before you're about to get your mortgage. That way you have no deductions from your monthly net income, and your net income is then multiplied by 100 on its own, allowing you to qualify for just that much more. Tip number 6, use an existing property towards your new mortgage. If you, your parents, your grandparents, or any family relatives own a property in Germany, then you can use it towards your new mortgage. Now, there's two main ways you can do this. The first way is as collateral. The second way is a cash-out loan. If you decide to use it as collateral, then the way that this works is you get a new mortgage, but the bank uses the one that you currently own, the property that you currently own, as additional security. This doesn't increase the maximum you can afford by too much. What it does affect is your interest rate, because by giving the bank additional security, they're able to offer you better conditions. Now, the disadvantage of doing this is that you won't be able to sell your existing property for at least 10 years. So keep that in mind. The second option is to get a cash-out loan. What you're doing here is you're basically taking a property that you own, you're pulling equity out of it, and you're using that to buy a new property. Now, imagine you own a property that's worth 500,000 euros. And you want to buy a property that costs 300,000. Now, of course, you could take your equity, as in your savings, and you could make a little down payment to get an expensive mortgage. But alternatively, what you could do is you could take your existing property, go to the bank and say, hey, my property is worth 500,000. I want to get a loan of 300,000. Now, 300,000 relative to 500,000 is not that big of a loan amount, allowing you to get better conditions because it's a low risk loan for the bank. And then you can use that money that you borrowed at a cheaper rate to buy a brand new property. So that's a cheeky way that you can use your existing property to boost your maximum affordability. Tip number 7, build your own home. As you might know, when you're buying a property in Germany, you don't only need to have a down payment, but there are mandatory purchase fees which you need to cover. These include the property transfer tax, the notary fee, and the real estate agency fee. Now, when you buy a plot of land on which you plan to build your own home, the property transfer tax is multiplied by not the total cost of the mortgage, but only the plot of land. So for example, if my plot of land costs 100,000 euros and the construction for my home costs 100,000 euros, the 6% property transfer tax which I would need to pay in Berlin is only multiplied by 100K. And there you have it. 7 practical ways to increase the maximum you can afford when buying a property in Germany. Thank you for watching. I hope you found this video informative. If you liked it, please like, comment, subscribe. As always, it really helps, and we hope to see you in the next video.